good morning, everybody, and welcome to this Tuesday, November 12th, 2024. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats. It's a pleasure to be with you this morning. We may have a glitch from time to time. We are trying out a new system this morning. I'd love to have your feedback, how things appear on your screen. You can just type that into the questions box. Just let Tyler know. We'll keep striving to improve the appearance. And well, we can't do it much about me, but maybe the quality of the show and what you're seeing. So please check that out and throughout the show today, and just let us know anything that you happen to see. I will tell you that we've on this new machine, we've got this watermark down here that we'll be taking care of later. It's going to show up on all the screens, so apologize for that. But we will get that taken care of later in the week before we do another show. Do also want to mention, go through the futures. We have the diamonds, which track the Dow Jones, currently up about 1.5 of 1%, so 0.15%. The spider right now is flat. The QQQ is exactly flat as well, and the IWM, which has been on a tear, is actually down almost 0.6% today. So get a little bit of a pullback on the small caps, but we've been seeing so much strength there. That's not too surprising. It is option expiration week. Normally when the market's on a roll like this, as we get further and further into the week and closer to options expiration, or even into the beginning of next week, because remember, a lot of folks will exercise their options, and as a result, market makers are still on the opposite side of the trade. That's why max pain and the impact of max pain can carry into the following week. So just want to be aware of that. But as we get further and further into the week, and perhaps even into the early part of next week, we might see some selling out of nowhere. And part of it could be just folks taking profits, but there also could be a little bit of a financial incentive for market makers to bring prices back down. I'll also add that many of the companies that do trade frequently in the options world, a lot of the large cap tech names, they haven't performed as well as like the small caps. So there may not be quite as much in the money call premium as you might think. Anyhow, we'll be having an event later today for our members at 4:30. I think it's 4:30, maybe it's 5. Anyway, I have to check the calendar on that myself. But we will be having an event later on. So if you do want to be part of that and you're not currently a member, we do have an opportunity. I'll show you our homepage where you can sign up for a 30-day free trial in just a bit. But anyway, got all that out of the way. So let's start with our market recap today. Going to change things up a little bit on how I present this as well. So let me know, what you think. But I'm going to go through each one of these charts individually and give you the big chart rather than try to focus on that little chart. First, the Dow Jones Industrial Average yesterday up about 0.7%. It was another 304 points. Another all-time record high, closing at 44,293. So that is our first close above 44,000 on the Dow. Next up, the S&P 500. S&P 500 also setting a new high and also moving above another 1,000 point psychological level, closing above 6,000 for the first time ever, closing at 6,001. We were only up about 6 points, which was 0.1%, but still up is up. We continue this move to the upside since testing the 50-day moving average. The NASDAQ 100, you can see also moving up, establishing new highs, closing above 21,100. And that was down about 0.05%. So really not much. We did see a little bit of a sell-off there. But again, it was that rotation because we saw, the NASDAQ drop. We saw S&P rather flat. And then you look at mid caps, which broke out to a new high over 3,300 for the first time, 3,325. Mid caps gained almost 0.9%. Then we had the small caps gaining 1.5%. So that's what I was talking about earlier. In futures, we're down a little bit in the IWM, but you also have to realize we've had such a big move in small caps. So that move to the upside, very, very strong, moving back above 240. Or not a back above, but actually above 240 for the first time ever. was really nice, clearing 234 and change. That was middle part of last week. That occurred and took out the all-time high that particular day, and we're seeing continuing strength. Even though we're looking to be down in futures this morning, I wouldn't be surprised to see small caps green again at some point later today. There's a lot of strength in that area right now. Transport's also making a breakout. So we've been talking about last month or so, the strength that we've been seeing, the breakout that we saw on the transportation average back in mid-October, pulled back to the 20-day. I was a little nervous, if you recall, about all these tails, where we were selling off and just weren't able to sustain gains throughout the day. But we never failed to hold the rising 20-day moving average. And then we broke out again on what I would view as an extremely bullish Maribozu candle. That's where you open on the low and close on the high roughly. So it's basically up all day long. We saw that last Wednesday. That was one of the big beneficiaries of the presidential election results. Folks just poured into transportation stocks, and we got another breakout yesterday with the transports jumping 1.22%. So those are some of the major indices. Let's take a look at the sectors and what happened among the sectors. So here is consumer discretionary gaining over 2%. That was our big winner on Monday. It's been now 5 consecutive days in a row. A lot of gains off of this 20-day moving average. And notice as we were going up back in early September, we pulled back. We went a little bit below the 20-day, but essentially held that 20-day, broke out again, kind of going sideways, holding on to price support, a little bit below the 20-day, but then right back up again. And now you can see that this is just extending. It's continuing to accelerate the strength to the upside. And it's not just price action. Look at the XLY down here on the bottom. Part of that, no doubt, is the huge run-up that we have seen in Tesla. Tesla has gone from $240 to $340 in not that long a time. So that is adding to the strength that we're seeing in consumer discretionary right now, as Tesla, I believe, I don't know what it is now after the big advance, but I know it was around it was about 15% of the XLY. I mean, it could be up closer to 20% after what we've seen here in the last week or so. But anyway, discretionary leading, that's a good sign. That's an aggressive group. 2 other areas that I really like. These are sectors that love Q4. I was talking about this before we ever even went into Q4. Financials and industrials love the fourth quarter. And you can see since early October, just straight up, I mean, we've gone from 45 to 50. We're already up 10% on the XLF just in the last, less than a month and a half. And it really didn't even start then. We started this all the way back beginning of August. So it's been a big run, and it continues on the financials, gaining 1.42% yesterday. Industrial, similar run. Yesterday up 0.77%, so almost 0.8%, but also breaking out. You can see again, strength that continues here in fourth quarter. So we do want to be aware of that. Real estate wasn't so strong yesterday, but we remain in an uptrend. I mean, here we went straight up for a while. I believe we're just sideways consolidating. I mean, maybe this turns into a slight move, a little bit of a channel to the downside. I was looking maybe more for sideways consolidation, but maybe we move down a little bit. I think real estate will jump back up again. I believe with rates historically, when rates are lower, real estate does pretty well. I know we've had a pretty decent jump in that 10-year Treasury yield of late, and it was actually jumping in this morning. And that could have a little bit of a headwind impact on the XLRE. But I don't really think the 10-year Treasury yield is going to go flying to the upside. I think it's going to settle down in the 4s, maybe later drop back into the 3s. But I think that yield is going to uninvert, which is going to free up a lot of capital liquidity and availability. And I think that's going to help the real estate market down the road. So I don't think this group's going to lead the market necessarily, but I think it'll participate as we go higher later this year and into 2025. All right, industry groups. Wanted to point out autos. Here is the impact of Tesla. And you can see it's just been a massive move. Since we gapped up back on October 23rd or 4th or whatever, that was with Tesla's earnings. We gapped up. We actually made a breakout on Tesla. It's not really showing here. It looks like just equal highs, but we made a slight breakout on Tesla. We pulled back. We went to the top of the gap, hit the 20-day moving average, and took off. And that's almost the exact same scenario we're looking at here on the autos. So I think things are looking up for the auto group. I think we continue to move higher. Obviously, there's been a big run. Expect some profit taking along the way. But I do think a more significant uptrend is underway now in both Tesla and the auto group as a whole. Airlines. I mean, here, this is part of the transports that have been doing extremely well. Going back to that August 5th low, it has been a straight up move in the airlines. Not really much to add here, but it did jump another 3.4% yesterday. If you're waiting on a pullback or waiting on a 20-day test, we haven't seen one since the end of August. So this is one of those cases where overbought remains overbought. And if anything, maybe continues to get more overbought. But those things happen in a secular bull market advance. Investment services breaking out. This has been a key area within the financial space. I remember, Goldman Sachs being added to our long-term list back when investment services were weak. Now we're seeing investment services take off, and Goldman Sachs has been a big winner as part of this run to the upside. Let's see. I think there was another, recreational services. Again, just another big move, not even almost getting a 20-day test, but really not for the last 5 or 6 weeks since back at the beginning of October. So recreational services jumping another 2.75% yesterday. Just another key area of the market that just keeps riding higher. All right, 10-year Treasury yield. So the 10-year Treasury yield, let me get an update here. I wanted to point out a couple things, and that's why this is on a 5-year chart. So I'm more interested in focusing on the big picture when it's going up and down relative or versus just looking to see what the candles are showing. Today, I can tell you we're up about 8 basis points to 4.39%. I think as long as we stay below the 5 back that we saw back in 2023, I think this market's fine. The one thing you have to understand about the market and the bond market in particular is that the yields go up for different reasons. The yields were going up for the last few years because of investors wanting higher returns because of inflation issues. So anytime there's an inflation scare, you're going to see the yields on the 10-year Treasury yield rise because folks are going to sell. They're not going to want to hold bonds if inflation's going up because they're bonds there that you have fixed income. And if inflation's going up, you're losing money sitting in bonds. So that's what triggers the selling. And of course, the selling price action goes the other way, opposite the yield. So when you're selling and the bond prices are going down, the yields are going up. So anytime we have an inflation scare, you're going to see that 10-year Treasury yield jump. And so we're seeing it jump here over the last 2 months. And you might say, well, there it is. Maybe inflation's still a problem. Well, that's where this intermarket relationship, I think, comes in, looking at the financials relative to the S&P 500. I want you to go back to late 2020 and into early part of 2021. We were still kind of following the yields to the upside. In other words, when the yield goes up, what we typically see historically is financials tend to outperform. Because normally when that 10-year Treasury yield's going up, it's a sign that the economy is strengthening, and it gives financials the opportunity, the ability to potentially make more profits because of the net interest margin, the spread between what banks, their interest expense in terms of when you put your money in a bank and you get a CD, the amount that they pay out for CD and checking and so forth, if that still remains low. And then on the flip side, you get loans going up because the 10-year Treasury yield's going up. It widens and makes a bank more profitable. It kind of fattens that profit line. And so normally what you see is when the yields are going up, it's a sign of a stronger economy or a strengthening economy. And you normally see banks do well, financials do well. Well, check out, once, we got into the more inflationary period, which started right around March, April of 2021. We didn't exactly see the same pattern that we normally see here. 10-year Treasury yields going up. Financials aren't doing any better. That's because yields are going up for the wrong reasons. It's all inflation driven. It's an inflation scare. That's not good for financials. That's not good for equities in general. But now look what's happened as we move up. Now we're starting to see what we saw back in 2020, early 2021, before inflation became a problem, and we're going up and financials are leading. This is more of a normalization of what I would expect from not only what the bond market's doing and where the 10-year Treasury yield's going, but how that's impacting the stock market. All right, volatility index, the VIX, you can see ever since the election last week, I talked about the VIX a little bit before the election. I said, it just seems to me like the market's just nervous about the election because the stock market wasn't exactly selling off. It wasn't a bad market, and yet the VIX was remaining high. So it was trying to figure out why was it up so much and why did it stay up? Well, we never got the breakout, which was good for the equity bulls. And once the election was over, look at the huge gap down at the open. VIX went down 5 or 4 at the open on Wednesday of last week. And we've continued down. And now all of a sudden, the rising lows that we saw in the VIX they're gone. They've been eliminated. Now we have equal lows. And if the VIX takes one more tumble, you can't point to the VIX any longer for a bearish position in the market. I think if anything, the VIX would be supporting a bullish position in the market. So that was one of the issues that I would have a check mark in the bears column. And I think that check mark's been erased. I'd say right now it's a little bit more neutral, but really favoring the bulls anytime you get back down below that 17 level. And as soon as the election was over, where did we go? We gapped down just below 17. So I think the VIX looks pretty solid here. All right. Let's take a look. I wanted to go through breakouts and breakdowns, and I just wanted to show you on stock charts. If you're on your dashboard and you scroll down to your scans, if you click on this more button there, you'll see predefined scans. This is an easy way. Stock charts has already run a scan. Here's your 52-week highs, and if you want, you could go down here to 52-week lows. Doesn't mean that you necessarily broke out yesterday. We could be in some stocks where, we've been breaking out day after day after day after day after day, and we're extremely overbought. That's really not what I'm looking at or looking for in terms of breakouts. What I want to do is try to find stocks that are just now breaking out of patterns where they've been going sideways for a while. And while this won't guarantee you, this will at least give you a little bit better chance of catching those. Let me show you what I would do. So once you go into this predefined scan list, the very first one shows new 52-week highs. You can get them by index if you want, or by category, New York Stock Exchange, the NASDAQ, over the counter. If that's your thing, that would not be mine. I normally would focus on these first two columns, the NYSE and the NASDAQ. And the NASDAQ is kind of underperforming some of the value and some of the IWM, some of the smaller companies and so forth. I probably would focus more on like the New York Stock Exchange. And so when I click here, it will tell you over here on the far right, you get this working here a little bit. Over here on the far right, it gives you the market cap, mid cap, small cap, large cap, whatever it is. Then if you sort by scooter, what I would do is take this and scroll down. If I've got a stock that's got a scooter of 99, if you don't understand what a scooter is, it's Stock Charts Technical Rank. Stock Charts Technical Rank. That's just an acronym. Stock Charts Technical Rank, SCTR. And I just call them scooters. Anyway, a scooter it's a relative strength indicator based on how a stock's trading relative to its moving averages and how far away it is from its moving averages. You can go into Chart School and get a definition. Just search SCTR and you'll have all kinds of different articles to take a look at, or in Chart School. But anyway, if you got a 99 reading, chances are you've been a very strong stock. So for instance, let me pull up LUMN. I mean, this stock took off back in July and August, and now it's just relentless to the upside. It's gone up 50% in the last 7 trading days. That's a breakout, but it's not really one I want to trade because it's just so, I mean, if you're a momentum trader and you want to trade this, that's great. But you have to understand there's a lot of risk because a normal 20-day test will probably take this down about 25, 27%. So if you get in and you happen to get in at the wrong time, just when we're starting a sell-off back to the 20-day, I mean, you could be down very quickly. So the question just becomes, are you willing to take that risk? Now, what I would rather do is go back over here to this list and scroll down. And every one of these stocks are breaking out to 52-week highs. So it kind of makes sense to me that if we go all the way back maybe to in the 70s, the scooter's not very high, which tells me we probably haven't been going up day after day after day. And then we can kind of look for things that we want to find. I mean, back here in the 70s, we could be looking for small caps that are just breaking out. Mid caps, mid caps I like. GPI actually is one of them that I think looks pretty good, if I'm not mistaken. I think I saw this one the other day. But let's pull up GPI. Here, you can see that we were going sideways for about 3 months. We just gapped up and broke out, pulled back a little bit, and then yesterday we broke out again to another new high. Now, normally you might look down and say, well, this probably only averages 100,000 shares a day. Well, I probably wouldn't put it in our portfolios for that reason, because a lot of our members might buy it. I just don't want to trade something that doesn't trade many shares. But the other part of this equation is you have to realize it's a $400 stock. So how many stocks are you and I, or how many shares are you and I going to go out and buy of a $400 stock? I mean, I don't know about you, but I don't have billions in the market. And so I'm not looking to get any kind of massive position. I mean, 100 shares of the stock is $41,000. So I think the fact that it normally trades around 100 to 200,000 a day, I think that's plenty of volume for a stock this size in terms of share price. But anyway, this is what I look for on a breakout. I want to see sideways action and then a breakout, because I feel like I'm just starting an uptrend. I mean, look here as we were going sideways. This is the definition to me of sideways consolidation. When you get your 20-day moving average, you were in an uptrend, 20-day was above the 50, it comes back down below the 50, then you move up, it moves back up above the 50. That constant, or that movement back below the 50 and above the 50, kind of tells me that this stock's been consolidating. And now we're getting the break. We're coming up off of a center line test on the PPO. So the momentum is just starting to accelerate to the upside. To me, this is a better stock to trade than, and even this one has $30 to the downside. That's 7% risk. If you wanted to mitigate some of that risk, you buy half of whatever you're going to buy. And if it touched, next time it has a 20-day test, you buy the other half. There are ways to mitigate that risk and make it manageable. With the stock I showed you earlier, Lumen, it's 25% above its 20-day moving average. It's going to be hard to manage risk on that stock. You might get in, it might keep going up, and you might make a lot of money. But I'm just saying, a normal pullback and you're going to be down 25%. That's a lot of risk to take on. And it might be fine for some, probably not appropriate for most. So that's how I would go back and try to find these breakouts and breakdowns, is simply go back to the 52-week highs, the predefined scan. There's other ways to do it, by the way, but just looking at the predefined scan and then just clicking on the number of stocks and scrolling back, finding what you're trying to look for. And I could have gone through and found a lot more, by the way. Here we are in 77s. It's showing me the industry groups and the sectors. I just said I really like industrials. Look for the industrials, look for the financials, look for the discretionary stocks. Discretionary is breaking out, looks really good. So if I find, any size discretionary stock, I would consider it, but especially small and mid cap. Here, this stock traded 1.2 million shares. It's called Open Lane, KAR. Not really that familiar with it. It's in the special consumer services industry group. It is a consumer discretionary stock. It's small cap. Hey, why not take a look at this one? And you can see sideways consolidation. It just took off. So this one's got a little bit of room down to the 20-day, but the first sign of weakness back down anywhere close to 18.5, 19, I think starts to get really interesting looking at a stock like this. So you can create a watch list simply by going back and looking at those breakouts, those 52-week highs, and then sorting it by scooter and falling back and taking a look for what it is that's leading the market. That's the way I would approach it. So anyway, wanted to share that with you today. The next thing I wanted to do is go through a couple of member questions. So these are a couple of paying members at Earnings Beats. They've asked questions. I personally have a really hard time getting back to individual questions, and especially answering those questions just to one person. It's just not very scalable in our business for me to take on individual questions and write back all the time. So I do apologize to anyone who has written in and asked questions where I haven't gotten back. I think we're going to start taking more of an approach where we can take some of the questions that I think would appeal to a larger audience and try to go over those, especially questions that pertain to our membership and that a lot of our members may have questions about as well. So that's kind of the approach we're going to take. So the first question I had was, I have a mix of model and aggressive portfolio stocks. We maintain equal weighted portfolios at Earnings Beats, and we change them every 90 days. We call it a draft. We got our next draft coming up this week, within a week. Anyhow, I've got a mix of these model and aggressive portfolio stocks, and after earnings, they've done very well. I know they've done well. The entire portfolio, by the way. If you look at the portfolio down at our homepage and then click on this, it'll take you over here. This is updated through yesterday. This quarter alone, which ends in a week, but this quarter alone, model portfolio up 21% versus the S&P 7%. We've tripled it. And the aggressive portfolio is almost quadrupled it, 26% versus 7%. And this is no fluke. I have been telling members, and I told everyone the theme going into the last draft, when we drafted these stocks 3 months ago, I said small caps and mid caps, financials, industrials. These are the areas we need to be focused on because these are the areas that are likely to lead over the next 3 months. That's exactly what's leading, and you can see how it relates to our portfolio results. Now, do we always get the themes right? No. But I lay out the reasons for the themes, what I like, individual stocks I like, and why. And then our members can decide. You can do nothing with them. You can buy a couple. You can buy them all. I mean, whatever you decide, obviously, is your risk. I can't take on that risk for everyone. But it does need to be mentioned. We are not registered investment advisors. I am not a registered investment advisor. I cannot recommend or advise you, provide advice to you. I'm not licensed to do it. We do this for educational purposes. We do this to show folks you can beat the S&P 500. And these are the funds. Now, the income portfolio, we don't try to beat the S&P 500 because in a bull market, income stocks are not going to outperform the S&P 500. If you want to beat the S&P, you need to be in growth. You need to be in aggressive areas. So, or for the last 3 years, you need to be in the Mag 7. I mean, if you're not in the Mag 7, you're probably underperforming. So anyway, but getting back to this question, they've done really well after earnings. What is the recommended sell date for this round of portfolio if I hold until the end? Is it August 27th? Is it November, the end of November? Is it the end of December? Or is it now, given the huge pop? All right, again, we do this for educational purposes. You can see down below here, this is the period that this portfolio runs from, August 19th, 2024 to November 19th, 2024. November 19th is Tuesday. We will announce our new portfolio stocks on Monday after the close. So we're going to have an event on Monday that's going to be our draft. And we're actually doing something new this quarter. We're announcing all of the draft picks at the very beginning of the webinar. So I think a lot of folks don't want to go through all of the themes and everything else, which if you don't want to, that's fine. I think it's important. I would at least go back and look at the recording if you just want to get the stocks and move on. But we are going to give out the stocks at the beginning of the webinar and then and move on from there. Anyhow, but the answer to your question is we're getting out on the 19th, which is next Tuesday's close. If we decide to do something different, like maybe a day or two early, we might do that. Just pay attention to the daily market report or the weekly market report when those come out, because that's where it would likely be announced if we do something. I might even send it out a separate email if I were to do something like that. But normally we would hold right through next Tuesday, the 19th. I do know November, I think it's like the 18th to the 20th tends to be a week period. So could we, end it this week on Friday, maybe. That might be a reason to think. It's also option expiration week. Some of these stocks might be subject to a lot of in-the-money calls. So it's up to everyone's, figure it out, whatever you want to do, whatever you're comfortable with. But we will either close them out next Tuesday at the close, or we will announce to folks in advance sometime during this week if we want to get out earlier. All right. Last one. As much as I discuss relative strength, why don't I include it on long-term charts? So I think what the member was asking is, we put out a weekly market report, weekly market report. And on that weekly market report, it's much more long-term focused. And we have a lot of stocks that we have talked about owning from a long-term perspective. Buy and hold, not buy for 90 days, not buy for 6 months, buy and hold. And we've only removed one since we started doing this 15 months ago. There was only one stock we've removed. Everything else, when we enter it, it just stays in that portfolio, and we look at it as part of our report every week. The reason I don't put relative strength on that chart is that we're buying for a different reason. This is not a momentum trade. This is a long-term, look at the long-term chart. Buy good companies when they're on sale. So if anything, a lot of these charts are relatively weak. They're showing relative weakness when we put them on the list. Because again, it's not about the momentum. It's about buying stocks that pay nice dividends and have nice dividend growth, buying them when they're cheap. But the main caveat is these stocks need to have a really good long-term record, going back 20, 30, 40, 50 years. And so pullbacks in the past have represented opportunities, and that's what we're doing with that weekly, those long-term charts. And that's why relative strength is not on those charts. If it is, I'm probably not paying much attention to it. So anyway, I wanted to let you know about that. All right, last thing I want to mention is we do have an event coming up on Saturday, small caps and mid caps. I have been talking about it. I've been preaching this since the beginning of the year. I said this was coming. And what I was waiting for is for rates to drop. Once the market believed that the Fed was ready to start cutting rates, small caps have blown large caps out of the water. That occurred back in the beginning, or like maybe the middle of the second week of July. Small caps have outperformed, the IWM has outperformed the QQQ probably by 16, 17 percentage points since the second week of July. Some people maybe aren't noticing, but small caps are already flying. Now they've finally made a breakout to an all-time high, and I think that strength accelerates. And I'm going to talk about it on Saturday. This is a free event. All you have to do, go to our website at earningsbeats.com, both plural, earningsbeats.com, click on small caps, click on that thing we showed you, and let me get that out of the way. I don't know why that shows up. But all you have to do is go in and put your name, email address, register now. No credit card. We're not going to ask for any money. All you need to do is come in and listen. Folks, we're building a community at Earnings Beats for a reason. We're trying to help folks that are constantly behind the market. They wait until the market goes up and gets really strong before they want to buy. And then they wait until it gets really horrible, and then they decide to sell. Most individual investors get it all wrong. You've got to be able to act on things when they're in the process of occurring. This is going to be a big event. If you're managing your own portfolio, or if you're managing portfolios for others, if you're a portfolio manager or whatever, you need to come in. You got to check this stuff out. We do a lot of research at Earnings Beats, and we are willing to share to some degree that research with our entire community. So make sure you go to earningsbeats.com, click on the small cap link, come over here and just sign up. Make sure you're registered for the event. Anyhow, that is it for me. I appreciate everybody tuning in. We can take I will take one last look and just tell you what the market's doing since we're 5 minutes in. Dow's up 72. We got the S&P up 3. On a percentage basis, Dow's up about 0.15%, just like it was in pre-market. Small caps have recovered a little bit. They're down about 1/3 of 1%. Mid caps about 1/5 of 1%. But let's see how the rest of the day goes. right now, I think the market continues to be in a position where it wants to go higher. Just keep in the back of your mind, we do have options expiration this week, so we may see some profit taking and possibly a little bit of a manipulation by market makers as we go into the latter part of this week and into early next week. But I really think we're going to get a strong finish to the end of this year, and then we'll take it from there. But anyway, have a great day, everybody. I'll see you next time. Happy trading.